Welcome back to the deep dive. Today we're tackling something pretty huge in the tech world, Alphabet's Q3 2025 earnings. These reports are often dense, packed with numbers and jargon. Our job, our mission for you, is to cut through all that noise. We're going to take the official press release, compare it against what the market expected, those consensus estimates, and really figure out what drove the performance. It's never just about the headline number.
Exactly, because on the surface, Alphabet dropped what looked like an absolutely stellar report. Big beats everywhere. But we need to dig deeper. Was that stellar performance from the core business, search ads, cloud contracts, or was it something else, maybe something temporary? We're going to use our structured framework, break it down piece by piece, and find those crucial aha moments for you.
Right, separating the signal from the noise, as they say.
Precisely. And the big tension this quarter, the thing everyone's debating, is this. Yes, there was a massive earnings beat, a really big one, but was it operational? That's the key question we need to answer. We'll show you exactly how it happened and, importantly, why the core business might have been just a little softer than that headline suggested.
Okay, that sets the stage perfectly. Let's dive right in. Now for slide 1, the at-a-glance scorecard. So looking at this first slide, the raw numbers for Q3 2025 are, well, they're pretty stunning. They definitely beat what Wall Street was expecting. Let's start with total revenue. Came in at $102.3 billion. That's quite a bit higher than the consensus estimates, which were clustered around, $99.75 billion to maybe $99.9 billion?
Yeah, kite range there. So hitting over $102 billion is a significant beat on the top line.
Yeah.
And hitting that $100 billion mark for the first time in a quarter, well, that's a major milestone, a big headline grabber.
Definitely. And then there's the earnings per share, the EPS figure. This often gets even more attention initially.
Always does.
Alphabet reported a diluted EPS of $2.87. Again, substantially higher than the consensus estimate. What was that figure?
The street was looking for $2.27. So coming in at $2.87, that's a 60-cent beat. On a number around $2, that looks like, explosive growth. Really catches the eye.
60 cents is huge. Now let's look at the growth rates year over year because context matters here.
Absolutely. The total revenue, that $102.3 billion, represents 16.0% growth compared to Q3 last year, which is, pretty healthy for a company of Alphabet's immense size.
16% is solid, but the EPS growth.
That's where it gets even more dramatic. Diluted EPS was up 35.4% year over year. 35.4%.
Wow.
Yeah. And typically when you see profit growth running at more than double the rate of revenue growth, 35% versus 16% here, that usually signals really strong efficiency, scalability. Investors love to see that.
Okay, but before we dissect why that 35% growth figure might be a bit misleading, let's pause for a second. We keep saying diluted EPS. Can you quickly explain for everyone listening why we focus on diluted specifically, not just basic EPS? It's important.
It really is crucial. You'll always see two EPS numbers, basic and diluted. Basic EPS is straightforward. It just uses the number of common shares currently outstanding. Simple math.
Right.
But diluted EPS is the one investors, analysts, everyone serious really keys in on. Why? Because it's the more conservative, let's say, comprehensive picture. It takes into account all the shares that could potentially be created in the future.
Like from stock options.
Exactly. Stock options for employees, convertible debt, warrants, anything that could turn into common stock down the line. Because including those potential shares increases the denominator in the EPS calculation. The share count, it usually results in a lower or diluted EPS number.
So it protects investors from surprises later on.
Precisely. It gives you the most cautious view of earnings per share, assuming all those potential shares do come into existence. So yeah, $2.87 diluted EPS is the figure we need to analyze.
Okay, got it. So $2.87, 35.4% growth. Sounds amazing. But here's where our deep dive really kicks in. We need to peel back the layers because that massive beat, that huge jump in profit, it wasn't primarily driven by the core business selling more ads, signing more cloud deals.
This is the core insight of slide 1.
The main driver was something else entirely. It was a huge, frankly, enormous surge in a line item on the income statement called Other Income Expense Net.
Right. You often see smaller numbers there, maybe some interest income or expense.
Exactly. But this quarter, it ballooned to $12.8 billion. Just compare that to the same quarter last year, Q3 2024, when it was only $3.2 billion. It's a massive jump.
Almost $10 billion more. So what was in there?
When you dig into the details, the footnotes basically, you find the primary cause, a $10.7 billion net gain on Alphabet's equity security investments.
Okay, so let's translate that. These are basically paper gains, right? mostly unrealized gains on their huge portfolio of investments in other companies, often private venture capital type stakes.
Exactly. It's Alphabet acting like a massive VC fund on the side. And while it's great, their investment team picked some winners.
It has almost nothing to do with the actual operating performance of Google Search or YouTube or Google Cloud. It's financial income, not operational income. And it can be incredibly volatile quarter to quarter. You can't bank on that.
Absolutely not. It's not sustainable profit from the core engine.
But here's where the company's disclosure is actually helpful. They specifically broke out the impact for us. They stated that these non-operational investment gains, that $10.7 billion, increased the diluted EPS figure by 0 to 68 cents per share.
68 cents.
Yeah.
Just from those paper gains.
Yeah. And knowing that number allows us to do the crucial calculation. We can strip out that volatile non-operational noise and figure out what the real underlying operational EPS was.
Okay, let's do that math right now for everyone. You take the reported diluted EPS, which was $2.87. And you subtract that $1.68 impact from the investment gains.
Right. $2.87 minus $1.68 leaves you with approximately $2.19 per share.
$2.19. Now here's the kicker. What was the Wall Street consensus estimate before all this investment gain noise?
They were expecting $2.27.
So the actual operational EPS, the earnings from the core business, came in at $2.19. That's actually below the $2.27 consensus.
Exactly. It wasn't a beat operationally. It was actually a slight miss, about an 8-cent miss on the core business profitability, completely hidden, completely masked by that huge $10.7 billion financial gain.
That is fascinating. The headline screams massive beat, but the reality underneath is slight operational miss.
And that is the critical lesson from this slide. The initial headlines, maybe the first market reaction, focuses on the $2.87. But the careful analyst, the deep dive, looks at the $2.19 versus the $2.27 expectation. That $1.08 operational miss, while not huge in absolute terms, changes the entire narrative. It suggests maybe the core advertising margins weren't quite as strong as expected. Or perhaps, and this is key, the heavy investments in AI are hitting the P&L a bit harder or faster than analysts had modeled. That small difference is what matters for valuation.
It really highlights why you can't just read the press release headline. That beat was, as you said, a volatile distraction. The real engine, while still incredibly powerful, maybe wasn't firing quite as strongly as hoped.
You definitely can't build a long-term investment case on one-off unrealized gains from a VC portfolio.
Now, there was one other thing boosting EPS, though much smaller. Share buybacks, right?
Correct. Alphabet continued its significant share repurchase program, spending $11.5 billion buying back its own stock during the quarter.
Which is a huge amount of money, $11.5 billion.
It is. And what that does mechanically is reduce the total number of shares outstanding. Fewer shares mean the same amount of net income gets divided by a smaller number, which nudges the EPS figure slightly higher.
We saw the share count drop a bit.
Yeah, the diluted share count went from about 12,419 million down to 12,203 million. So the buybacks definitely helped the $2.87 number, providing a small conventional lift.
But compared to the $1.68 impact from the investment gains,
it was really just background noise this quarter. Important for capital return, yes, but the main story of the EPS beat on slide 1 is absolutely that non-operational gain masking the slight operational shortfall.
Okay, that makes sense. So we've dealt with the headline volatility. Let's now focus on the core business efficiency. Moving to slide 2, the engine of profitability.
Right, so this slide is all about operating margin, basically. How good is Alphabet at turning a dollar of revenue into actual operating profit? Just like with EPS, we have a big asterisk this quarter, a significant one-off item we need to adjust for.
Another adjustment. What is it this time?
It's a major legal fine. Alphabet had to book a $3.5 billion charge related to a fine from the European Commission, the EC.
Okay, $3.5 billion. Where does that show up?
It hit their general and administrative G&A expenses.
Oh.
So if you just look at the standard reported numbers, that fine drags down the operating income and the operating margin significantly.
And that's not really reflective of the ongoing business health, right? They hopefully won't be paying massive EC fines every single quarter.
Exactly. Which brings us to this really important distinction between GAAP and non-GAAP profitability. GAAP stands for Generally Accepted Accounting Principles, the official audited numbers.
Which must include the fine.
Correct. So under GAAP, Alphabet's operating income was $31.2 billion. That gives you a GAAP operating margin of 30.5%. Still a very healthy margin, objectively, but lower than it would be otherwise.
30.5%. Okay. But then there's non-GAAP.
Right. And non-GAAP figures are provided by companies specifically to help investors understand the underlying ongoing performance by stripping out unusual or non-recurring items like, well, a multi-billion-dollar legal fine or maybe big restructuring costs, things like that.
So they calculate an adjusted number.
They do. They show you the math. They take the GAAP operating income, 31.2B, and add back the $3.5 billion fine. That gives you an adjusted non-GAAP operating income of $34.7 billion.
Okay, $34.7 billion versus $31.2 billion. That's a noticeable difference.
It is. And that translates directly to the margin. The non-GAAP operating margin comes out much stronger at 33.9%.
33.9%, so nearly 34%.
Yeah. And for investors trying to model the future, that 33.9% is arguably a much better indicator of Alphabet's true sustainable profit-generating power than the 30.5% GAAP figure that was weighed down by the one-time fine.
Right.
It shows the engine's efficiency without that temporary burden.
Okay, but I have to ask the question probably on some listeners' minds. When a company gives you two sets of numbers, GAAP and this adjusted non-GAAP one, isn't there a risk they're just, picking the number that looks better? How do we make sure it's legitimate?
That's a very fair and important question. Skepticism towards non-GAAP is healthy. The key is transparency and consistency. Companies are required by regulators, like the SEC, to provide a clear reconciliation they have to show exactly what they adjusted and why, bridging the gap from GAAP to non-GAAP.
Ah, okay.
And in this case, adjusting for a massive, clearly defined, non-recurring legal settlement like the EC fine, that's generally considered a perfectly reasonable and helpful adjustment. It allows for better comparison quarter to quarter and year to year. Where you get suspicious is if a company starts adjusting out things that seem like, well, normal costs of doing business quarter after quarter, but this fine is pretty clearly a one-off.
Got it. That makes sense. So using that cleaner non-GAAP lens helps us see the underlying efficiency, and that lets us talk about a really key concept for long-term investors, operating leverage.
Exactly. Operating leverage is kind of the holy grail of scalable business models.
What does it mean in simple terms?
Positive operating leverage simply means your operating profits are growing faster than your revenues. So if revenue goes up 10%, but profit goes up 15% or 20%, that's positive leverage. It signals that the business is becoming more efficient as it gets bigger. Each additional dollar of revenue costs less to generate.
Okay, so let's apply that here. Revenue growth was 16.0% year over year.
Right. Now, if we had only looked at the GAAP operating income, remember that only grew 9.5% because of the fine. That would actually be negative leverage profit growing slower than revenue. Not a good sign.
But the non-GAAP number tells a different story.
A completely different story. The adjusted non-GAAP operating income grew by 21.6% year over year, jumping from $28.5 billion last year to $34.7 billion this quarter.
21.6% profit growth versus 16% revenue growth.
Bingo. That is clear, undeniable, positive operating leverage.
And what does that tell us, practically?
It tells us that even while Alphabet is pouring just colossal sums of money into R&D, into building out AI infrastructure, into these huge data centers, all things with high fixed costs, their core business engine is so incredibly efficient and scalable.
That the profits are still growing faster than the sales.
Exactly. The marginal cost of delivering their services, especially in the core advertising business, is low enough that overall profitability expands even with massive reinvestment. It's proof that the business model scales beautifully. They're getting more efficient even as they grow larger and invest heavily.
Okay, so the overall machine is running very efficiently. Now let's break it down further. Which parts of the machine are really humming, and are there any parts that are maybe sputtering a bit?
Let's turn our attention to slide 3, the engine room business segment performance. Right, slide 3, we're diving into the individual segments. First up, the behemoth. Google services. This is the core, right? Search, YouTube, Android, hardware, everything.
Pretty much everything except cloud and the moonshots, yeah. This is the financial fortress. And how did it do? Revenue growth was 13.8%, which seems pretty solid for such a massive base.
13.8% is definitely solid. And remember, we have to apply that same logic about the EC fine here. The reported operating income growth for services looked a bit weak. Only 8.7%.
Because the fine hit the G&A within services.
Exactly. But if you adjust for that, the underlying operational profit growth for Google services was actually much healthier, probably closer to 20.0%. So the core engine is still throwing off cash and growing profits nicely.
Okay, 20% adjusted profit growth is strong. Now, inside that 13.8% revenue growth for services, were there differences between, say, search and YouTube?
Oh, absolutely. And this is where it gets really interesting for understanding the digital ad market right now. The growth wasn't spread evenly at all.
What do you mean?
Well, the core owned and operated platforms showed fantastic strength. Google Search and other related advertising grew 14.5% year over year, reaching $56.6 billion. That's the bedrock, still growing strong.
14.5% on that base is huge. And YouTube.
YouTube ads also performed very well, growing 15.0% to $10.3 billion. It continues to solidify its position as a key advertising platform, moving beyond just, simple display ads.
So search and YouTube both up around 15%. Very strong. What else is in services?
There's another really bright spot, the category they call Google subscriptions, platforms, and devices. This includes things like Google One Cloud Storage subscriptions, YouTube Premium, YouTube TV, maybe revenue from the Play Store, Pixel hardware sales, perhaps.
Okay, the recurring revenue stuff plus hardware. How'd that do?
Exceptionally well. It grew 20.8% year over year to $12.9 billion.
Wow, over 20% growth there. That's significant.
It really is.
Yeah.
Because it shows Alphabet is successfully building these more predictable recurring revenue streams. Getting users to pay directly for services like storage or ad-free YouTube adds a layer of stability and resilience to the overall model, making it less solely dependent on the cyclical ad market. Growing that at 20% is impressive.
Okay, so search strong, YouTube strong, subscriptions other, very strong. Was there any weakness within services?
Yes, there was one notable weak spot, Google Network.
What's that exactly?
This is the revenue Google generates from ads placed on third-party websites and app sites that use Google AdSense or AdMob, for example. It's not ads on Google.com or YouTube.
Got it. And how did the network perform?
It actually declined. Revenue fell 2.6% year over year to $7.4 billion.
Down 2.6%. That's quite a contrast to the 15% growth in search and YouTube.
It's a stark contrast. The implication here is pretty clear, I think. Advertisers seem to be really focusing their budgets. They're consolidating their spending onto Google's own platforms, Search and YouTube, where they likely see the highest return on investment, the highest commercial intent.
And pulling back from the broader web.
It looks like it. Spending on the third-party network, which can sometimes be lower quality or have less direct intent, seems to be getting cut first when budgets tighten or advertisers optimize. It points to a flight to quality within digital advertising, concentrating spend on the biggest, most effective platforms.
Interesting. Okay, so that's Google services mostly strong, but with that network weakness. What about the other major engine, Google Cloud?
Google Cloud. This was, without a doubt, the standout operational highlight of the entire quarter. The big victory.
What were the numbers?
Revenue growth accelerated significantly. Cloud revenue jumped 33.5% year over year, reaching $15.2 billion.
33.5% growth. That's accelerating from previous quarters.
Yes. And that acceleration is so important. It's really the tangible proof investors were looking for, that Alphabet's massive spending on AI, the chips, the data centers, is translating directly into winning more business, gaining market share, and meeting the surging demand, especially for generative AI services.
So the investment is paying off on the top line. What about the bottom line, cloud profitability?
Even more impressive, frankly. Explosive growth. Google Cloud's operating income grew an incredible 84.6% year over year.
84.6%.
84.6%, reaching nearly $3.6 billion in operating profit for the quarter.
Okay, wait. That kind of jump, 84.6% profit growth, is that sustainable? Or is it just a one-time effect of finally reaching scale after years of losses or tiny profits? Are they like buying market share with low prices?
That's exactly the right question. And while 84% growth every quarter isn't realistic, this surge confirms a fundamental shift. Cloud is a business with incredibly high upfront fixed costs. You spend billions building the infrastructure.
Right.
Once you reach a certain scale and your data centers are utilized efficiently, the cost of adding the next customer or selling the next bit of computing power drops dramatically. That's when the operating leverage kicks in hard. This 84.6% jump signals that Google Cloud has definitively crossed that threshold.
Yeah.
It's achieving significant scale, and the profitability is now flowing through very strongly. It's not just growth for growth's sake. It's increasingly profitable growth.
And they have visibility into future revenue too, right?
Yes. Management highlighted a cloud backlog figure of $155 billion.
Wow, $155 billion. What does that represent?
That's the value of contracts already signed with customers that Google Cloud expects to recognize as revenue over the coming years. It provides really strong visibility and confidence that this growth trajectory especially driven by long-term AI and data deals, has legs.
Okay, so cloud is firing on all cylinders. What about the last segment, other bets? The moonshots.
Right, other bets. This is where you find things like Waymo, autonomous driving,
Yeah.
Verily, life sciences, and other longer-term high-risk ventures.
And how did they do financially?
As you'd expect for these kinds of speculative projects, the financials are less rosy in the short term. Revenue actually declined by 11.3% compared to last year, and the operating loss widened slightly to $1.4 billion for the quarter.
Oh, well, $1.4 billion loss. That sounds like a lot.
It is a lot in absolute terms, but the key here, again, is context. You have to view that loss relative to Alphabet's overall profitability.
Right, compared to the tens of billions in profit from services and now cloud.
Exactly. The core businesses generate so much profit that they can easily afford to fund these $1.4 billion quarterly losses in other bets. It's the cost of innovation, the price of potentially hitting a home run with something like self-driving cars years down the road. While you monitor the losses, they're currently very manageable within the bigger picture.
Makes sense. Okay, we've looked at operations. Let's look at the foundation supporting all this. Now for slide 4. Financial strength and shareholder rewards.
Yeah, slide 4 is all about the balance sheet and how Alphabet uses its immense financial power. And the headline here is that their financial position is just incredibly strong, like a fortress.
How strong are we talking? Let's start with cash.
Okay, at the end of Q3, Alphabet had $98.5 billion classified as total cash, cash equivalents, and marketable securities.
$98.5 billion, just shy of $100 billion sitting readily available.
Pretty much.
Yeah.
That's an enormous cushion. It gives them incredible flexibility to make acquisitions if they want, to fund massive investments, which we'll talk about next, or just to ride out any potential economic storms without batting an eye. It basically de-risks the company from a financial standpoint.
And what about debt? Are they heavily leveraged?
Not at all. That's the other side of the coin. We can measure this with the debt-to-equity ratio. You take their total liabilities, all their debts and obligations, which were about $149.6 billion,
Okay.
and you divide that by their total stockholders' equity, which is about $386.9 billion.
So $149.6 billion divided by $386.9 billion.
Gives you a debt-to-equity ratio of just 0.39.
0.39. What does that signify?
Generally, any ratio below 1.0 is considered conservative, meaning the company relies more on equity than debt financing. A ratio below 0.5, like 0.39, is extremely low. It indicates minimal financial risk, very little leverage.
And that's crucial if you're planning to spend huge amounts on future projects.
Absolutely essential. You need that pristine balance sheet, that low debt level, to give you the freedom and the investor confidence to commit tens of billions of dollars every year to things like R&D and capital expenditures, which Alphabet does.
Okay, so incredibly strong balance sheet. And that strength allows them to do what you call the capital return flywheel.
Yeah, I think that's a good way to describe it. Yeah. They generate such an immense amount of cash from their operations. Just look at this quarter, $48.4 billion in cash flow from operations alone.
$48 billion in 3 months. That's staggering.
It really is. And with that flood of cash, they can do two major things simultaneously. They can invest aggressively back into the business for future growth, and they can return significant amounts of cash directly to shareholders.
How are they returning it? We mentioned buybacks earlier.
Right. Share repurchases are a key part. They spent $11.5 billion on buybacks in Q3. This reduces the share count, boosts EPS slightly, and increases the ownership stake for the remaining shareholders. It's been a big part of their strategy for a while.
But there was something new this time, right? A dividend.
Yes, and this is a pretty significant milestone for Alphabet as a company. The board initiated a quarterly cash dividend of $6.21 per share.
21 cents per share per quarter. Why is that significant?
Because for years, Alphabet, like many big tech growth companies, reinvested basically all its profits back into the business. Starting a regular cash dividend signals immense confidence from management and the board in the stability and predictability of their future cash flows. It's a direct, tangible return of cash to shareholders every quarter. It often appeals to a different, perhaps broader class of investors as well. It's a sign of maturity, in a way.
So you put it all together.
You get this powerful cycle. The core ad business generates massive high-margin profits. That cash funds the huge investments needed for AI and cloud dominance. And there's still enough left over to return billions to shareholders through buybacks and now this new dividend. It's a self-reinforcing loop of profit, investment, and return.
Having their cake and eating it too, indeed. Okay, we've seen the past performance, the efficiency, the financial strength. Now let's look forward. Finally, we conclude with slide 5, the road ahead management's outlook and key takeaways. All right, slide 5, connecting the dots and looking towards the future. What was the tone from management on the earnings call?
Understandably, very positive, very bullish. CEO Sundar Pichai highlighted the overall strength, calling it a terrific quarter with double-digit growth across all major segments. He specifically called out hitting that $100 billion quarterly revenue mark for the first time.
Acknowledging the milestone, did he give any more color on the AI momentum?
He did. And crucially, he moved beyond just saying AI is important. He provided a specific, quite impressive metric. He said their large language model, Gemini, is now processing 7 billion tokens per minute just through direct API usage by customers.
7 billion tokens per minute. What does that signify?
It's a concrete measure of adoption. It shows that businesses are actively using and paying for Google's core AI capabilities right now at a massive scale. It's not just hype, it's real usage generating real activity. And he also reiterated that $155 billion cloud backlog figure, reinforcing the long-term demand picture.
So strong current results, strong indicators for future cloud and AI demand. But then came the really big news, the thing that maybe reset expectations for the next year or two.
Yes. The absolute centerpiece of the forward-looking commentary, the signal that dominated investor conversations afterwards, was the updated guidance for capital expenditures, or CapEx.
The spending on data centers, servers, infrastructure, what's the new number?
Management now expects total CapEx for the full year 2025 to be somewhere between $91 billion and $93 billion.
91 to $93 billion.
Billion, with a B. It's a truly staggering amount of money.
How does that compare to, well, anyone else? Or their own past spending?
It's monumental. It likely puts them among the very highest, if not the highest, corporate spenders globally. It represents a significant step up even from their already massive investment levels. This isn't just routine upgrades. This is a declaration.
A declaration of what?
It's basically an all-in bet on winning the AI infrastructure race. Management sees the exploding demand evidenced by the cloud acceleration and that Gemini token metric, and they are committing whatever capital is necessary to build out the capacity to meet it and stay ahead of competitors like Microsoft and Amazon. It signals that they believe that returns on AI investment will be enormous, justifying this unprecedented level of spending.
So the strong cloud results basically gave them the confidence to double down massively.
That seems to be the read, yes. They're saying, we see the wave coming and we're building the infrastructure to ride it, whatever the cost.
What does that $90 billion plus CapEx number mean for investors, though? Especially thinking about cash flow.
That's the crucial implication. This instantly becomes the single most important variable to watch. Why? Because CapEx directly reduces free cash flow. Remember, free cash flow, FCF, is typically calculated as operating cash flow minus capital expenditures.
So if CapEx jumps to over $90 billion,
even with Alphabet's massive operating cash flow, their free cash flow number is going to be significantly lower, potentially much lower, than it would have been otherwise. The spending will put considerable pressure on near-term FCF generation.
So management is making a trade-off.
Absolutely. They are explicitly prioritizing long-term strategic positioning and technological leadership in AI over maximizing short-term free cash flow. They're telling the market, trust us, the long-term return on this $90 billion investment, primarily showing up in future cloud growth and AI services, will be worth the near-term FCF pressure. It's a bold bet, and the market will be watching closely to see if that cloud growth continues to justify it.
It really ties everything together, the need for the core services profit to fund this bet, the validation from the current cloud acceleration.
Exactly. It defines the entire narrative going forward.
Okay, so let's try to synthesize this whole deep dive. We've gone through 5 slides, lots of numbers. What are the key takeaways for you, the listener, to really grasp from this Q3 report?
I think we can boil it down to 4 main points.
Okay, takeaway number 1.
First, the headline beat was misleading, or at least non-operational. Remember that $2.87 EPS beat, driven almost entirely by the $1.68 from volatile investment gains. The core operational EPS of $2.19 was actually a slight miss versus the $2.27 consensus. Always look under the hood.
Got it. Look past the headline. Takeaway number 2.
Second, cloud acceleration is the real operational story. That 33% revenue growth and, even more importantly, the 84% jump in cloud operating profit. That's the core victory. It validates the past investments and shows the AI strategy is gaining tangible, profitable traction right now.
Cloud is the engine proving itself. Okay, number 3.
Third, the $90 billion plus CapEx commitment is the future strategy. This defines everything going forward. It's the massive bet on AI infrastructure, the key driver of future growth, but also the primary pressure point on near-term free cash flow. This is the number to watch.
The massive bet defines the road ahead. And finally, takeaway number 4.
Fourth, core advertising and subscriptions remain the foundation. Don't forget the fortress, that solid 14–15% growth in search and YouTube, plus the 20% growth in recurring subscriptions. That provides the incredibly stable, high-margin cash flow needed to fund the $90 billion CapEx bet and the buybacks and the new dividend. The core enables the future.
Okay, that ties it together nicely. The final narrative then is
Clear validation, I think. Alphabet's strategy using the ad empire to fund a historic AI and cloud build-out seems to be working. We saw proof in the cloud results this quarter, and the massive CapEx guidance signals they're doubling down, setting up a very high-stakes race for dominance in the next era of computing.
And hopefully, using this kind of structured 5-part framework helps you, the listener, see those underlying dynamics and not just get swayed by the initial, often volatile headline numbers. So here's a final thought to leave you with, building on that CapEx discussion. If this demand for AI keeps surging, if competitors keep pace with their own massive spending, how high could that $90 billion number actually go? Is there a point where even Alphabet's mighty profit engine starts to feel the strain, where that positive operating leverage we saw this quarter begins to erode under the sheer weight of investment? That's the balancing act, the key tension to track moving forward.
It's always about connecting the dots, the numbers, the strategy, the future implications. Thanks for joining us for this deep dive today.
And just a couple of important reminders before we go. First, the financial disclaimer. This report is for informational purposes only. It doesn't constitute financial, investment, legal, or tax advice. Always do your own research and consult with a qualified financial professional before making any investment decisions.
And second, the AI disclaimer. This report was generated by an artificial intelligence model. While efforts have been made to ensure accuracy, errors, or omissions might occur, please independently verify any information you rely on.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.